Hey, what's up, real estate investors? This is Aaron Nelson, founder and principal of White Coat Holdings. We're a real estate investment company that buys large apartment complexes all throughout the United States. And today I'm here to talk to you about a question that I get from a lot of different investors, and that's what's the difference between a multifamily real estate syndication and my traditional stock or ETF investment? In a prior video, we covered the ways investment real estate helps you build wealth through not only capital gains or appreciation, but also through having your tenants pay down the mortgage you have on that property, and through increasing the income it generates or lowering the expenses to create cash flow, which can often be as high as 6 to 10% a year. With stocks, you're really just banking on the old mantra of buying low and selling high because almost all of your returns come from capital gains. But savvy investors also have to assess risk because, as we know, there's risk involved with every investment. So today, I want to spend some time talking about how both stocks and real estate syndications are impacted by different investment risks. So with that, let's dive in. One of the first risk factors that we'll talk about here is changing consumer behavior. And this is highly influenced by, first of all, how the economy is doing, and secondly, technology. So every day there's new technology that's coming out onto the market and has the potential to make certain companies obsolete. A perfect example of this is Kodak, which used to be a blue chip stock in a Fortune 100 company. Then all of a sudden there was a rise in digital photography, and now, Kodak's shares are worth far less than what they were. The economy also has a large impact on consumer spending. So obviously during times when the economy is doing well, they're going to spend more money. In comparison, when the economy goes down, they spend less money and the economy contracts. And so that again can have a very large impact on the stock market. Whereas with real estate is a basic need of humans. At the end of the day, people need a place to live. And during an up economy, people tend to go out and maybe they decide to rent a little bit more of an expensive place. So maybe they go and they live in that nice new A-class apartment that was just built down the street in your town, and it's got all the fun amenities. And during a down economy, they'll trade in that really nice high-end apartment for maybe a B or C-class apartment like what we invest in, because they still need a place to live, but they want to save a little bit more money. And so at the end of the day, the likelihood that technology or that the economy is going to obsolete real estate is very, very low when you invest in B and C class apartment complexes like we do. Another risk factor is market volatility. And with stock prices, you're often heavily influenced by human emotions. So look at what just happened with the share price of Peloton just because Sarah Jessica Parker's fake husband died on a Peloton bike. It just crashed just because of some TV show. And compare this against multifamily real estate, where you're dealing with a lot more sophisticated investors that don't get as emotionally attached to their real estate investments, and ultimately they're going to run the property like business owners. The other thing that we talked about before is that multifamily real estate generates cash flow. And that's a huge advantage because, again, if the market goes up or down, it doesn't matter. As long as you're still cash flowing on the property and making money, you're going to be doing all right. So that's a huge advantage with real estate. The risk of new competitors coming out on the market is definitely something that you have to be aware of when you're a stock investor, because that can have a huge impact on your investment portfolio. So, new companies every day are coming onto the market and competing for market share. And that can really have a very large impact on how well the companies that you're investing in might be doing. So compare this against real estate investing, and there's really high barriers right now on building new multifamily products. So for one thing, it's really expensive. There's huge supply chain shortages. There's huge labor shortages. Another thing is that a lot of the new competition that comes out on the market, when it's a brand new apartment complex, that's all high-end A-class product. And those apartment units are going to rent for a lot more than the B and C class products that we tend to invest in as multifamily syndicators here at White Coat Holdings. You can insulate yourself somewhat from this risk of new competition by picking the right markets, by picking the right asset classes to invest in, and that can give you a really huge advantage. So the last thing I want to talk to you about here is control and transparency over your investments. So I don't know about you, but if I went and I bought Tesla stock, I don't think that all of a sudden Elon Musk is going to start answering my emails or phone calls and talking business strategy. That's a pretty big difference in comparison with multifamily real estate syndication, whereas if you're investing, you would likely have a personal relationship with one of the deal sponsors, and you can talk to them about what their plans are for their company and for the investment and how they're going to add value to the property. So to wrap things up, I hope this video has helped you think through how multifamily real estate responds differently, and in a lot of cases more resiliently, to common investment risk factors when compared to stocks. A lot of people invest in apartment syndications to provide more stability to their investment portfolio. Thanks for watching. I'll see you next time. Hey, I hope this information was helpful to you. Thanks so much for watching. For more great content, please go to www.whitecoatholdings.com/learn. Thanks so much, and I'll see you next time.